There are ETFs that allow you to play on stock market volatility directionally, up or down. But what about ETFs that aim to capitalize on the income potential from volatility? Ooh, that sounds juicy. 40% distribution rates? Sure, why not? What besides nothing could possibly go wrong? Coming up on today's program, we've got an audience-requested ETF battle, this time between volatility income funds with yields to the moon. From Simplify and VolatilityShares, stick around. Welcome to all. You're watching ETF Battles. I'm Ron DeLegge. This is season 6, and I hope everyone's doing well. If there's an ETF battle you'd like to see, please send me your ETF ticker symbols in the comments section below. We could do double, triple, and quadruple headers, so make it good. Also, visit the description section. I've got links to our program judges. Get in touch. I've also got a link to our program sponsor, Direction. And be sure to visit direction.com. Check out their growing lineup of ETFs, which includes single stock funds linked to Mag 7 companies like Tesla and NVIDIA. Learn more at direction.com. Now, we've also got one more resource for you, ETFK Retire. Yes, you heard right. ETFs and 401k plans, that's our solution. So again, you'll find that and more in the description section below. So today's audience requested ETF battle is from a viewer named Minas, and it's between SVOL and ZVOL. These are volatility income ETFs from Simplify and VolatilityShares. Judging today's volatility contest, we've got a duo extraordinaire. We've got Athan Psarofagis with Bloomberg and Mike Akins with ETF Action. Guys, great to see you.
Hey guys, nice seeing you.
Great to be here.
We're going to blaze through our 4 battle categories, giving each of our judges an opportunity to give us their preferred choice. For our mystery category, our judges can choose a single factor or multiple factors that they feel are pertinent to today's matchup. Our judges can also nominate wildcard ETFs if they think there's something better elsewhere. Keep in mind, none of the battle outcomes are ever known in advance by myself or our judges, nor are they ever predetermined. So let's kick things off with the first category, cost. Mike, please get us started.
Awesome. Well, it's good to be here, Ron. Thanks for having me. On the cost side of things, for these two products, they're both expensive in ETF world. SVOL come in at 72 bips, 142 bips on ZVOL. So on the cover of things, SVOL is the cheaper of the two products, but they're both selling volatility to create income. They're doing it in varying degrees of risk. So your expense ratio on this whole game is not going to be a big component in your determination on which one of these two products you want to use. But just on pure cost basis, assuming liquidity is very similar between the two, SVOL does come in considerably cheaper at that 72 basis points.
All right, got you down for SVOL. Thank you, Mike. Athan, you're up next. How do you see it when it comes to cost?
Hey guys, no, that was great. Yeah, like Mike alluded to, they're not cheap overall by the grant, by overall standards. 142 basis points for ZVOL, 72, still high, but that's half of ZVOL. SVOL has also been around a lot longer. It's got more in assets. It's almost close to $1 billion, which is really impressive for something like this. It trades a lot more, so I think the spread's a little bit tighter there. So I think this is a pretty clear winner that SVOL is the overall total cost cheaper. So I'll give that one to SVOL.
Exposure strategy is the next category. This is where we take a look at the underlying fund strategy. And so break it down for us, Athan. How do these two ETFs compare?
Now, Mike was sort of alluding to it. So the main thing is it's for investors looking for different types of yield, however we're getting it. This is a big thing in the ETF industry now. So essentially they're just selling vol, but to different degrees. And if you remember back in the day, there was like XIV, the product's not around anymore, but this is how this trade got really popular. So SVOL is the yield, it's a little bit lower, meaning that it's not doing a 1-for-1 inverse of the VIX. It's doing anywhere from only 25 to 30% of it. So it'll be a little bit less volatile. It's also using options to kind of mitigate that volatility. SVOL is a -1 of the midterm VIX. So there's different structures, right? There's really short term, there's midterm and long term. This is just sort of targeting the middle. I think one of the reasons for that was the XIV issues with the really short term ones. It tends to be very volatile in the middle of the curve. So it wanted to sort of mitigate that. So they're just targeting the middle of the curve. So it's just a little bit different strategies. You're going to get a lot more juice in SVOL just because it's not using any options, any other kind of like vol mitigating strategies. It's a tough one. I think if you want the most pop, you're going to have to get ZVOL because these are, but for someone looking for more steady income, a little bit less volatility, SVOL is probably your winner. And just for that, I'm going to give this one to SVOL just because I think it's a little bit more of a predictable return path compared to like stocks or something, but just between the two, it's a little bit more predictable, and so I think you have less of an issue of any sort of outsized event. So I will give this one to the simplified product SVOL.
Solid takes. Thank you, Athan. Mike, you're up next. How do you see it when it comes to exposure strategy?
Yeah, so on the strategy front, I think Athan did an excellent job explaining the nuances between the two products. Essentially, you get the full inverse with the ZVOL, meaning inverse VEX or VIX proportionally a full inverse, which in result gives you a heck of a lot more volatility, which is why it's going to kick off a much larger income stream by selling that volatility and collecting that premium. Whereas SVOL tries to take away a little bit of that volatility by dialing it back to that 20 to 30% range. And to that extent, they're both going to have moments of shock, right? So just recently on Liberation Day, both these products, when the VIX popped up, they both got smoked pretty well. But SVOL got smoked about 25%, or relative to the ZVOL. So the selling volatility is not new. I think you need to know what you're doing, and you need to understand that, hey, I'm going to pick up this premium for long periods of time, but then from time to time, I'm going to have to restart, and I expect to lose a significant portion of that asset. It's a very disciplined game. To that extent, if this is something you're looking to utilize inside of a portfolio for some uncorrelated income generation, whatever it may be, I think SVOL is better suited, just because of you still can get very, it can still be very volatile, but relative to ZVOL, it's not even on the same page. It's 1 quarter, so it's a big difference on that front. One thing I would say, and just generally, a lot of times people say you're selling vol, you're picking up pennies in front of a steamroller. Just keep that in mind on these strategies.
Great analogy. We don't want to be steamrolled for picking up pennies, but it is worth noting that could happen, like you said, in really crazy.
It will happen.
Yeah, it will happen, exactly. In especially in periods of extended volatility, not just those spikes that we always get every now and then, but also what about sustained periods of high volatility? That could spell trouble. That takes us next to performance and yield. And Mike, you sort of alluded to this, so please elaborate.
Yeah, so performance on this front, the strategy in of itself is always going to get reset at some point when you have an event, whether it's COVID or whether it's Liberation Day or whether it's whatever causes the market to have a spike in volatility, a vol spike. You're going to have a reset in your return. So you're thinking about it, really from a standpoint of how much risk, how big of a reset am I willing to take to pick up income in the meantime? So obviously ZVOL is kicking off about 4 times the amount of income that you're seeing in SVOL, which is still kicking off a lot of income, 12, 13% versus 40+% in ZVOL. So the yield, obviously you're going to get more with ZVOL, but you're also going to have much larger drawdowns when those vol spikes happen. So it's up to you as the investor. What can you stomach? How disciplined are you to sticking to the strategy? Again, I think that the odds are more people are going to be able to stick with SVOL. And from that perspective, I'm just going to continue to give the win here to SVOL from a standard use case. Now, if you're really into this and you understand how you're using it, if you have a hedge on the other side of it, there could be a reason to go a little bit further, but you really need to know what you're doing.
Athan, you're up next. How do you see it when it comes to performance and yield?
Yeah, that was great. And this is where it gets kind of complicated because the yield on ZVOL is 40%, 41, and it's about 17 on SVOL. That's a big difference, right? It's enough to get someone thinking like, do I want to buy ZVOL and handle and be exposed to more of the volatility, more of the drawdowns, and even just on a total performance basis, ZVOL's done better. And kind of like Mike was alluding to, this is going to work until it doesn't, right? And then it can be really, really ugly, and so I guess like you said, as long as you know what you're doing, I think it's just tough to ignore the 41% yield on SVOL. I get that's just such a significant gap over the other one. Performance, even though I had picked exposure SVOL, performance, I'm going to give it to ZVOL just because you get so much more juice on the way up. But again, being aware of all the risk factors and things like that you could see with ZVOL, so just something to keep aware of. But the yield you're getting is just significantly much more than SVOL. So I'll give it to ZVOL for this one.
Up next is our mystery battle category. This is where our judges can pick a factor or multiple factors that they think are crucial to today's contest. So, Athan, what is your mystery battle category, and which of these ETFs wins it?
Sure. So I think we'll look at taxes and because of income, right? And something to be aware of, depending, maybe if this isn't a tax qualified account, it's not a problem. But
I hate taxes.
Yeah, I think everybody does. But with these, unfortunately, because income is such a big driver of these, you're going to be stuck with a tax bill that you're going to have to pay taxes on. SVOL is much higher. A lot of it comes more for the yield than the price movement. So unfortunately, you're going to be paying taxes on that. So we're slicing it thin here, but from a tax efficiency standpoint, SVOL is slightly a little bit better than ZVOL. So I'll give it to SVOL.
Thank you, Athan. Mike, you're up next. What is your mystery battle category, and which of these two ETFs wins it?
Well, first, I'm really glad that Athan brought that up because taxes really should be mindful of how much, what you're going to be paying in taxes when you get this income, how is it structured, all that good stuff. So second, I'm also really glad that I get to have this mystery category with Athan on the phone and on the battle with me, because I think the mystery category needs to be Greeks. If you don't know your Greeks when it comes to selling volatility, theta, gamma, delta, then what are you doing owning this stuff? If you don't understand those terminologies and how it plays with respect to how selling volatility works, then you shouldn't be using it. And so to that extent, if you don't know your Greeks, Athan, I'm glad to know you, but then you shouldn't be in this strategy.
Yes, exactly. We know our Greeks. Athan's representing our Greeks very well. What do you have to say about that, Athan?
Yeah, no, it's you got to know all the good. Luckily, I still know all the Greek alphabet and stuff. But yeah, I think that's a really important point. Really understanding the relationships between how these things move between price and volatility. These are very complex products, so you really have to be well informed. So that's a good thing that Mike brought up.
Athan, I know you go to Greece like once a year. You're fluent in Greek, aren't you?
Yeah, I grew up speaking Greek. My parents are immigrants, so luckily most of my family's there. So they don't talk as much about these kind of Greeks. They talk,
Yeah, they're talking about other kinds of Greeks, probably the delicious Greek food.
Yeah, all the food. But yeah, I go back pretty much every year. Nice.
Well, this takes us now to the part of the program where our judges are going to give us their overall battle winner. So, by the way, Mike, I forgot to ask you about the Greeks. Was that a split decision on your mystery category?
No, there's no winner or loser. It's just understanding them.
Okay, gotcha. All right, so that takes us to our final portion of the program where our judges can give us their overall battle winner. So let's give it to Mike. Mike, break it down for us. Which of these two ETFs wins it, if any?
So no, I think SVOL, understanding it in a relative to a overall portfolio construct, positioning it properly, understanding, when you do have those vol spikes, what's inside of your portfolio is going to potentially hedge you from a little bit of that exposure. It can make sense from a generation of income, knowing your tax consequences of receiving it and all that good stuff, of course, is important. But to that end, if you're just building a portfolio, SVOL, I think that muted portion of that volatility, it makes a lot of sense. It's going to get people to stick to it. And, with a full inverse, the possibility of a complete wipeout is very, very real, right? And I think,
with both of these, or
I would say much less so with SVOL,
okay.
Right? Because you're not taking that full-on inverse exposure. And I don't think you'll get completely wiped out of ZVOL either, but you could get really close. So I think that's just the reason I would give SVOL the winner is it's easier to stomach in terms of how you would play it in context of building a portfolio. And that's what we do here at ETF Action. So that's how I like to talk about it.
Athan, your final chance with your overall winner?
No, that was great. And I love the analogy you brought up before about the steamroller. And I think anyone who's using these should always keep the XIV chart in the back of their mind. And that chart looks amazing, and it literally got wiped out in one day. That's all it took. Now, to Mike's point, these have been constructed to really try to avoid that. So the likelihood of having a total wipeout, like you said, is low, but you're going to have a greater probability or a greater drawdown in ZVOL. And like, again, we're talking about with April, and we saw this in 2024, a couple of periods, like the drops are now very swift and quick in the market. So, not saying that it's not a non-zero chance. And for that, I just think that SVOL mitigates a lot of that possibility. It's less likely that's going to happen. You're still getting a decent yield on it. It's a different type of strategy. And so I think the market's also speaking to that. And that's why that product has almost $1 billion in assets. And the other one it's a little bit newer, but it's not quite as big as SVOL. So just overall, I think that you're going to give up some of the yield, but I think being able to know that there's not that big chance of a wipeout is more advantageous for SVOL. So that would be my overall pick.
Well, our judges have spoken, and according to the final battle scorecard, today's winner is SVOL. And I think for our judges, for the most part, agreed. Lots of yield to be had, but at the same time, lots of potential red flags here. And I think our judges pointed that out. The chances for deep drawdowns in a volatility spike are very high. And so you have to balance out whether that's worth the time to accept that level of risk in exchange for a high yield. Of course, we all remember XIV. And if you don't remember, well, then you should Google it or chat GBT it or put it in your AI prompt, XIV, the wipeout. That is a part of the indelible history of volatility products in the ETF market, and it can happen. It can happen, and so you need to be aware of it. Again, I think our judges did a great job at highlighting all of the pros and cons of volatility-focused income ETFs on today's program. Manas, thank you very much for that excellent recommendation. We even talked about some Greeks, too. I always love to include the Greeks in the conversation, so that was also a good point made by Mike. Again, great job, Athan and Mike, for sharing your timely insights.
Awesome. Thanks for having me, Ron.
Yeah, this was great. Nice to see you guys.
Be sure to visit the description section below. We've got links to both of our program judges, so be sure to get in touch. Also, we've got links to our program sponsor, Direction. Go to direction.com. I'm Ron DeLegge. Thanks for watching ETF Battles. We'll see you on the next show.